In this lecture, we're going to cover Unit 3.3, which is current assets. So like already mentioned, the most common current assets found in most businesses are cash, marketable securities, inventories, and accounts receivable. Now we're going to cover each current asset in detail. Cash and marketable securities are actually considered to be one. So because when most of us use the term cash, we mean currency, and we also mean the bank demand deposits. However, when corporate treasurers use the term, they often mean currency, demand deposits, and addition of very safe, highly liquid, marketable securities that can be sold quickly at a predictable price and thus be converted to deposits. So therefore, cash as reported on balance sheet generally includes short-term securities, which are also called your cash equivalents. So these are your marketable securities. Now, businesses usually do keep some currency with them. For example, if you have a hotel, a movie theater, or whatever business, you need some cash in hand for the operations, for the daily operations. However, with time, the importance of cash has become less after the rise of credit card, debit cards, and other payment mechanism. Moreover, keeping too much cash can lead to higher capital cost and may even tempt robbers. So it is preferred to keep more amount in the form of demand deposits. Now there are some points that we will discuss in demand deposits. Number one is hold marketable securities rather than demand deposits. It is preferred to hold marketable securities rather than demand deposits because on marketable securities you do earn some interest and demand deposits usually do not earn any interest. And moreover, because marketable securities are so easily sold out in the market that you can actually convert them from the security into cash in just one day. So that's why it is preferred that even if you require money in emergency, marketable securities will be paying you interest and you can convert them really quickly into cash in order to meet that urgency as well. Then you have borrow on short notice, point number 2. So firms can establish lines of credit under which they can borrow with just a telephone call if they need extra cash. However, they will have to pay fees for those commitments, and those cost of fees must be considered when deciding to use a borrowing capacity rather than using marketable securities. Then the third point is forecast payments and receipts better. So the better the firm can forecast its cash inflows and outflows, the smaller will be its need to hold a lot of cash and there will be less unexpected requirements. So it will improve the whole liquidity management and they can hold liquid assets and reduce the amount of working capital. So forecasting is very important for proper management. Then speed up payments. So firms can actually take actions to get their cash receipts faster. For example, there is a technique called lock box technique. It is basically a post office operated by a bank to which payments are sent, and it is used up to speed up effective receipt of cash. So instead of taking the checks coming to the corporation and then from the corporation going to the banks, they go directly into this lockbox and the lockbox is then taken over by the bank. So it actually reduces the time period of the invoices reaching the bank. Then is to use credit card, debit cards, wire transfer, and direct deposits. So if a firm switches from selling on credit to accepting credit or debit cards, again, this will make the payment mechanism more quicker and it will speed up the collections. Now we're going to discuss marketable securities. So some common type of marketable securities used are treasury bills, commercial papers, certificates of deposits, and money market funds. Now, marketable securities and demand deposits, the management actually requires coordination with each other. The higher that will be the demand deposits, the lower will be the marketable securities and vice versa. So firms purchase marketable securities as cash builds up, and they use these marketable securities, which means they sell them out when they require cash. Now, a good example is of Microsoft. Microsoft actually accumulated 60 billion of cash in the form of marketable securities in 2004. So it needed to hold some of those securities for liquidity purposes, but mainly the funds built up because Microsoft generated more cash from operations than it actually needed. Now, the investors actually urged the management to use this cash in a more productive manner, or they should pay the shareholders the amount back. So partly because of this pressure in the fall, Microsoft announced a one-time dividend of $30 billion. And it also stepped up its stock repurchase program and then reduced this $60 billion to just $6.6 billion, which was a more reasonable and acceptable amount. So you cannot hoard too much cash even in the form of marketable securities. Now, while considering marketable securities, a trade-off between risk and return is required. If the firm wants to earn high returns, they will have to invest in long-term investments. However, long-term investments will not meet the liquidity that the marketable securities should have. Therefore, treasurers will want to hold securities that can be sold very quickly at a known price, even though if the return is less, because they do not want to take too much risk with their marketable securities. And a third very important point for all of this cash and marketable security is a firm's relationship with its bank. Because the stronger the relationship that the business has with its bank, it can have a significant effect on the need for both demand deposits and even cash equivalents. Because if a business has a firmly committed line of credit under which it can obtain funds with a simple telephone call, it won't need much in the form of cash and marketable securities. In this lecture, now we're going to cover inventory management. There are basically four types of inventories in businesses. Number one is supplies, and if it's a manufacturing business, they will have raw materials. They will have work in process, and they will have finished goods. So inventory management actually means the management of all of these types of inventories, and a very good starting point for this is the sales forecast, because how much inventory will be kept will be dependent upon what is the sales that has been forecasted. Now, in the whole inventory management process, computerized systems really help in this regard. Basically, the best example for this is your supermarkets. Usually they have computerized system that keeps a track of each and every type of product and automatically sends orders when required. Computerized systems have also made possible just-in-time manufacturing system, which is a Japanese method, which calls for inventory to come only when it is time and when it is required in the production process. So there is no inventory kept as a buffer in this system, but for that you need to have a very accurate lead time calculation and management. Now over here, mostly the inventory management is important, but it is under the operation and control of the production manager and the marketing people rather than the financial managers. However, financial managers have to take into account three important aspects. First, it is that if the company decides to put in a computerized system, then the capital budgeting and the cost of doing so. Second is that the finance manager must be ready for any sort of increase in inventory holding, so they will have to make the amount available at the right time. And the third thing that the financial manager has a responsibility is for identifying any area of weakness that affects the firm's overall profitability using ratios. So for that, they're also going to look at how is the inventory being managed. Now, in order to see the inventory management, we have this ratio, which is your inventory turnover ratio. It is cost of goods sold divided by inventory, and it tells you how many times in a year is inventory being used up. This ratio is also converted into a day sale of inventory, which is 365 divided by the inventory turnover ratio. It tells you in how many days are you using up the inventory, or after how many days are you purchasing the inventory. Now let's look at an example of how are both of these ratios used. So the Flexo Paneling Company, makers of modularized office equipment, is going through its annual management review of inventory. Its treasurer has the following information. So the cost of goods sold is this much, direct material expense, raw material inventory, and total inventory. We're going to calculate the total inventory turnover, which is calculated by cost of goods sold divided by your inventory amount. So your cost of goods sold amount is this much, and your inventory amount is this much. So you got an inventory turnover of 5 times. This tells you that this company is using up its inventory 5 times in a year, or you could say that it is purchasing its inventory 5 times in a year. This can also be converted into days to get the days sales of inventory. For that, you're going to use 365 and divide it by 5, which is your inventory turnover. So day sale of inventory is 73 days. Now this is telling you that in 73 days time, your inventory is being sold out, or you are purchasing your inventory in 73 days of time. Now, in order to come to a conclusion whether the inventory is being managed properly or not, this ratio should be compared with previous years, or it should be compared with other companies in the industry. So it can be used as a benchmark, or other companies can be used as a benchmark, and only after the comparison can you say whether the inventory is being managed properly or not. Basically, keeping too high of an inventory level is also not good, and keeping too low of an inventory level is also not good. Too high inventory level means that you will have to bear the storage costs, and there are chances that the inventory might get obsolete, and there are chances of theft as well, and so on. Whereas if you keep too low of an inventory level, then you run the chance of actually running out of inventory, which might lead to stoppages in the production process, and you might lose on a lot of sales. Now we're going to discuss the receivables management. Receivables are those customers from which you need to collect money. So there are funds that are due from a customer. Now over here, we will discuss the credit policies. It's a set of rules that includes the firm's credit period, the discounts, standards, collection procedures offered, and so on. Credit policy is very important because it has an effect on the sales. It will have an effect on the amount of funds that are tied up in your accounts receivable, and it will also have an effect on. Now, first we're going to discuss the credit period. Credit period is the length of time buyers are given to pay for their purchases. So for example, usually the credit policy is 30 days, and customers, they actually prefer longer credit periods because that will mean that they can pay later, and usually people do give customers a lot of time to make the payment in order to stimulate sales. However, the longer the credit period, the higher will be the receivables amount. That means your money will be tied up in the form of receivables for a longer time, and moreover, the longer the credit period, the higher will be the chances that the customers might default. Then the second point is discounts. So discounts are price reductions given for early payment. Again, this is a way that is used to stimulate sales. However, the discounts will lower the amount of revenue, and Okay, so the second thing is discount. Discounts are price reductions given for early payment. Now, these discounts, they will also help in stimulating sale, and they will also encourage customers to pay early in order to get the discount. However, it will also result in lower revenue amount being recorded. So a balance needs to be struck between how much discount should be offered. Then you have credit standards and credit scores. Credit standards means the required financial strength of acceptable credit customers. Now, with regard to credit standards, factors considered for business customers will include ratios such as the customer's debt and interest coverage ratios and what is the customer's credit history. Basically, you're asking the question, is the customer likely to be willing and able to make the required payment on the schedule? Now, if the standards are set too low, bad debt losses will be too high. And if the standards are set too high, the firms might lose many sales and thus profits. So a balance must be struck between the cost and benefits of tighter credit standards. Moreover, you might give credit scores to people which are a numerical score from 0 to 10 that indicates the likelihood that a person or business will pay on time. Then the fourth is the collection policy. Now, the collection policy refers to the procedures used to collect past due accounts, including the toughness or laxity used in the process. So at one extreme, the firms might write a series of polite letters and ask for the amount. And on the other extreme, they might give their accounts receivable to a collection agency relationship very quickly. So if you put excessive pressure, you can lose valuable customers, but if you do not put any pressure at all, then you might never get the amount back again. A balance has to be struck and a collection policy needs to be formed. Now, credit terms are the statement of the credit period and any discount that is offered. It is clearly given in a statement. For example, if it is written to 10, net 30, this means that it is allowing a 2% discount if the payment is received within 10 days of the purchase. If the discount is not taken, then the full payment is due in 30 days amount. Credit standards and the collection policies are relatively subjective, so they're not generally discussed in the published credit terms. So you just discuss these kind of things in your credit terms. Now we have established the cost of granting credit. However, it is possible to actually sell on credit and to impose a carrying charge on the receivables that are outstanding. Credit sales can actually be more profitable than cash sales. The best example for this is in the automobile sector. If you're buying something on credit, then automatically there is a carrying charge on it, and it is actually more profitable to sell on credit in that case. Now, like inventory management, we have a formula in order to look at the management of receivables, which is your days sale of outstanding. It is calculated by receivables divided by annual sales divided by 365. This will tell you the number of days, the average number of days in which the customers are giving back the money. So it is going to tell you in how many days you are collecting your receivables. Now let's look at an example for this. The new controller of the Flexo Paneling Company wants to determine the company's accounts receivable collection period. In the June accounting period, the beginning accounts receivable balance was 318,000 and the ending balance was 383,000. Sales for the year were 3,750,000. Based on this information, the controller calculates the average receivable period as follows. So this is the formula that we are going to use. Write down the formula over here as well. It is sales written it incorrectly. So we're going to calculate the day sale outstanding, and the formula for that is receivables divided by your annual sales divided by 365. Now for your receivables amount, you can see that they have given you the opening and the ending balance. So you can take the average of both of them. In order to take the average, you're going to take 318,000 plus 383,000 and you will divide it by 2. So this gives you an answer of 350,500. This is your receivables amount. The annual sales amount is 3,750,000 and this is divided by 365. So this makes it 350,500 divided by 10,273, and if you solve this, it becomes 34.1 days. So on average, the customers are paying their dues in 34.1 days. Now, if the billing date and the amount of credit allowed is 30 days, then the management has to work and reduce this from 34.1 days to 30 days. But if the credit policy allowed is 45 days, that means that the customers are paying within the due time and there is no problem.